Accounting equation and Excel. Apply customer deposit or credit to an invoice. The customer deposit or credit could also be called a prepayment from the customer, possibly recorded as unearned revenue. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. In Excel, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 4 tabs down below: example, month 1, practice, month 2, example, in essence, answer key. Month 1, prior month of operations. Practice tab, having pre-formatted cells so you can practice the practice problem with less Excel formatting. Month 2 tab, the one that we will be working in, is where we started with a blank worksheet but are basically working within a template at this time. However, we will be adding to that template as needed as we go practicing our Excel tools and formatting when we do so. Let's go on over to the example tab to get an idea of what we will be doing, remembering we're using the accounting equation basically as our trial balance to record our transactions using the double entry accounting system, from which we will then construct our financial statements, that being, of course, the balance sheet, the income statement, the statement of equity. Remembering the income statement could also be called the profit and loss report. So we're going to record an invoice, but we have a little twist to the invoice that we're going to record this time. Not only do we have inventory involved, but we have a prepayment, which sometimes we call a credit, that's in the system for the particular customer. Now remember that term credit can also have multiple meanings, because when we hear credit as a customer, oftentimes we see that as a good thing. They're going to lower the balance we owe them. If the credit card company says they're going to credit our account, we usually think that, okay, we equate that to lowering. But remember, it's in parlance of debits and credits, and I'll try to explain that a little bit so we get a fuller grasp of where that term came about and how it can be used more technically and more broadly in normal kind of language when talking to customers or to your credit card, or when you're dealing with people to try to get a credit maybe or something. All right, so remember the scenario here. We have an advance payment. In our situation, we are imagining that we want to sell guitars. Anderson, for example, customer comes into the shop, says, hey, I'd like this particular guitar. And we say, that's great. However, he wants some gaudy color of the guitar. And we're like, oh man, that's a interesting color scheme that you want on that. We don't actually tell him that because the salespeople are good at their job. They're like, oh, that sounds interesting. And he's like, he wants this crazy colored guitar. And we're like, okay, maybe we can order the guitar and get it for you, but we want to make sure that you give us a down payment so that we're not stuck with this ugly guitar if you don't follow through with it, because we don't want it in the shop, because it's kind of, we don't say that, but that's what, because it doesn't go with like our whole thing that we got going here. It's not our style, man. So he's like, so we need a $300. So what we could think of in forms is we might create an estimate type of form, which doesn't have a financial transaction related to it, but can give us an estimate to inform Anderson of what the cost will be. And then we could take a percentage possibly of that estimate and say, we want 10% down or whatever it may be, in order to lock you in to see that you are committed to actually purchasing the guitar. So that means that we enter from a forms standpoint, and like a QuickBooks, you might call that a payment form, meaning the payment form is kind of like a deposit form, but it's particular to the accounts receivable. It's the form that is connected to accounts receivable, usually decreasing the accounts receivable when the payment happens, because usually the payment happens after we deliver the guitar or do the works, goods, or services. In this case, we got paid beforehand. Now, the big problem that we talked about last time is that when that happens, I should put it into like a liability account called undeposited funds or customer deposit or something like that. The problem, however, is this is dealing with a customer, and I want to have a subledger that is all in one place and is lined up to one master account, one GL account, you might call it. And so that's why oftentimes in software, you might see negative receivables for this type of transaction. So that will annoy people from a book standpoint, from a financial statement reporting standpoint. But from a bookkeeping standpoint, it makes sense because you can imagine what we want to then be looking at is the subledger by customer. And I'd like to see if there was a prepayment, I would like to see the prepayment in the subledger. If I made another account called unearned revenue, then I'd have another subledger for the liability account of unearned revenue. And I'd have to somehow compile those two things together. Now, I think Xero has a system that does that pretty nicely and tries to keep all the financial statements correct, as not have an overstated accounts receivable and record the liability properly, as well as integrate the subledger. I think QuickBooks, some versions of it are starting to add more of that functionality in it, but no matter how you do it, it kind of complicates things. The simple thing to do is just to say, I'm going to make a negative receivable for the prepayment, which will then flip to a positive receivable once we make the invoice. We can fix that from a financial statement standpoint by just basically doing an adjusting entry at the end of the period for reporting purposes like we talked about last time. So that's what we're going to imagine at this point in time, where if I look at Anderson, we're going to imagine we somehow got the guitar at this time. So we have the guitar, and now we're going to basically invoice Anderson guitars for the full amount of the guitar, for which we already have this $300, which should be nice and easy because this $300 is already in the subledger. I would have recorded it if I'm talking about QuickBooks Forms terms with a payment type of form, which has not been applied to any invoice yet. But now I can make the invoice and apply these two things out so that it's in the same subledger, number one, and number two, I have that nice linkage between the invoice and the payment form from a form standpoint as well, which is a step beyond what we can usually do with just simply the double entry accounting system as we're doing here in what I would call like a two-dimensional spreadsheet double entry accounting system versus a three-dimensional kind of database program, which has the added ability to connect the forms basically together. All right, so that's where we're at right now. So now we're going to imagine that we have the guitar and we're going to invoice the client for it. Imagining maybe we're going to box it up and send it to them with the invoice like in the box, for example, hopefully trusting in this case that they're going to pay us for the amount that we have sent in that case. So now we're going to go, okay, let's do that. Let's go to the month 2 tab and let's do that. So on 2/26, we'll say that we're going to invoice for inventory on account. And it's going to be for Anderson guitars. Ba-boom. And I'm going to go, okay, let's do that. And then now in practice, if I had already made an estimate in order to tell Anderson how much the guitar would cost, and in order to make a percentage of that estimate as a down payment, I could then use that estimate form, which didn't actually record anything, but I would have a list of the estimates that I can then convert to an invoice. So, and if I convert it to the invoice, that would pull over the guitars that they wanted, which is we're going to say it's an ELP, one of those, and then an EPSH, we're going to say that there were 2 of those. So now we're going to create our invoice, which is going to have these items, and we'll say that the cost on the invoice is still $500 and $400. That's the cost, not that's the sales price, or what we're going to charge, not the cost or what we bought them for. So that's good. But we still have this issue that we have this $300 that had already basically been paid to us that we're going to have to account for. All right, so let's think about the transaction. Then we could say that now when I record this note, the invoice is going to have the same transaction related to it as though we didn't have the deposit before. However, the bottom line of the invoice, the amount that we're going to say you still owe us at the bottom of the invoice, will be reduced by $300. So let me see if I can explain that. So we're going to record it just like we would a normal invoice. The transaction will be recorded. We're going to say Accounts receivable is going to go up 500 times 1 unit, and this one's going to go up 400 times 2. I've got to also add the sales tax. I'm going to imagine, like always in our practice problem, there's a 5% sales tax. Let's go into this first one and multiply it times 1.05, 100% plus 5%, 105%, or 1.05. Let's do the same thing here, double clicking times 1.05, 105% to add the 5% sales tax. And then on the sales side of things, we're going to say in this cell, we're going to say this equals the 500 times 1 because there's one of them and there's no sales tax. This one equals the 400 times 2, and there's no, we're not including the sales tax over here, so no sales tax here. And then we'll deal with the sales tax as a payable. So when we collect on it, we'll collect the sales tax off income statement so that we can then pay it to the government, in theory, on behalf of the customer or client. 500 times 1 times 0.05. I'll show you that here. So it's the 500, which is that sale, times 1, because we just bought one of them, times the sales tax rate, 5%, or 0.05. This one's going to be equal to the 400 times 2 times 0.05. Okay, something happened there. Let me check it. It's going to be that times 2 times 0.05. I think that's right. All right, and then we can copy this formula down and see if we're still in balance. So I'm going to select all of them, copy this down. And so green 0, we're still in balance, so that's good. Let's put zeros across the board, and then I'll deal with the inventory side of things. And we'll deal with the subledger as well. So zeros across the board. And then I'm going to go into the subledger over here for Anderson Guitars. Now I'm in the accounts receivable subledger. I'm going to say that this equals the 525. And then this one, 0, 0, 0, 0, 0, 0, 0, 0, 0 across the board. Oh no, undo, Control Z, zeros, and not there. And then this one, once again, Anderson Guitars, is going to be 480. So that's the amount on the invoice that they can see. We'll do the inventory and cost of goods sold in a second, but note that Anderson's prepayment was up here. So once I apply the credit to the invoice, then the actual balance is that they owe us is 1,065. So there's a couple things I want to just point out here. When I create the invoice, then I create the invoice like I normally would. The transaction is going to be the same way, the way we're doing it this way. We'll talk about another method that you might use later, but the invoice was created the same way. And then we apply the credit to the invoice. Now, if you're thinking about QuickBooks, for example, or most software, this was created with a form. So you might have called it a payment form, right? The payment form was already created for Anderson Guitar, which is usually applied to an invoice, but there was no invoice to apply it to because it was a prepayment here. So what you might do is you might create the invoice, which doesn't have the credit applied to it, and then go into this form and apply it out. Or sometimes within the form, you could say apply out the available credits. It might happen automatically, but that's what you want. That's what you're thinking in your mind. You're thinking, I make a normal invoice, and then if you go out of the invoice and back into it, oftentimes the settings in the software will automatically apply out the credit, so that at the bottom of the invoice, it's going to say, this is the amount that we charge, that we're charging you, 1,365, and then it's going to subtract out the 300 that you already paid. That's the credit, giving you the balance that you still owe, which is 1,065, which they can pay us later, which we assume we're going to get paid on it, which will cause another payment form to happen down here that we can then apply out, and then everything will be worked out in that way. Other thing I just want to point out, this, why do we call this a credit? Like, where did that terminology come from? We're crediting your account this amount. And usually if you're like, you call your credit card company, they're crediting your account, meaning they're decreasing the balance that you owe them. So what does that, what does that mean? Well, look, in our case, if this is a accounts receivable, usually that goes up when people owe us money. So we do goods or services, we provide them, they owe us money. From a debit and credit standpoint, just right and left side of the equation, basically assets are basically debits and liabilities, and equity are credits. Therefore, the asset goes up with a debit, right? So that means that normally a debit to us is good, because that means people owe us money. So when I credit their account, what I'm really saying is I'm just doing, from a debit and credit standpoint, I'm crediting their account. I'm crediting an asset, which is bad for me typically, unless we got paid a cash for it. But if I'm just like negating the credit, like if I said, I'm going to give you a discount and I'm going to credit your account, well, that's kind of bad for me as the business, because now my assets are going down, right? You don't have to pay me as much because I credited your account. So just realize that from a normal language standpoint, the customer hears credit oftentimes as, well, that's good, because that means you're lowering my account. But from where the term credit came from, it just simply means that we're lowering an asset which has a debit balance, and therefore we're going to credit it, lowering the asset, right? It's just a ledger entry that happens to be a credit, right? That's where it comes from, just to point that out, because it's, anyway, I think that's useful information. That's why I pointed out. So now let's go, let's put this on the bottom. So I'm going to go to the view tab, and we're going to go to the unfreeze. Let's unfreeze the panes. And then I'm going to go put this on the bottom so I can see my subledger at the same time as this. Put my cursor on the little skinny over here, view tab and windows, and split the panes so that I can see this bottom bit, which is a little tight down here, but that's all I need. Well, I kind of like to see the date, but that's okay. I'll keep it there. And then I'm going to put my cursor up top and scroll all the way up and over to my subledger for inventory. And we're selling an ELP. So I'm going to bring the balance down here. And then this happened on, I think, 2/26. I'll just type in the date, even though I'd rather use a formula. And this is going to be -1. They cost us $400. So this is going to go 1 times 400. I'm going to make this green to indicate that that's the one I'm working on when I transfer it to my journal entry. So I'll pull this over to the ending inventory. $400. 1 times 400 is -400. Underline, home tab, font group underline, summing up the prior balance. 3 minus 1 gives us 2 units left. They all still cost $400. Therefore, 2 times 400 is $800 worth left of those ELPs. Let's look up the EPSH, which is over here. It's here and down one. So there it is. I'm going to say this happened on 2/26, and we're going to say that we sold 2 of those, and not for 400, but the cost of them, we sold them for 400, but they cost 320. So we're going to say 2 times 320 is that, pulling that to the ending inventory, reducing it by 2, costing 320. 2 times 320, 640, underline, home tab, font group, underline, summing up equals the sum, which is 5 minus 2, leaving 3. They still cost 320. So 3 times 320 is 960. And I'm going to make this green so that I can see it when I pull that into my transaction. Then I'll go back to the view tab up top, unsplit the panes, and go to the right, scroll up top. I want to put my cursor right here so I can still see those beginning balances. So I'm in A5, and then freeze the panes. And then I'll scroll down to the transaction we are on. Let's go to the inventory side of things. I'm going to say this equals 1 times, and then I'm going to scroll up to the subledger to find the costs, just so I can link it out. You could type it in there if you want. I think it's 400, but I'm going to go over and find it. That's why I made it green. So there it is. There's the 400, and that should give me a total of course, 400. It needs to be negative though. So I'm going to double click on this. Inventory is going down, put a negative, and then the cost of goods sold. Cost of the goods sold is 400. So now we've got the 500 minus 400's net income went up by 100. Remember that the invoice isn't going to show the cost on it, but it will be recorded as we record the invoice. So if we're using a perpetual inventory system. And so this one is going to be equal to 2 because we sold 2 of these times. I'm going to go find it, scrolling all the way up, scrolling to the right, scrolling, scrolling, scrolling. Keep those doggies scrolling, 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 raw. Sorry, that's a song. So it's 320. That should give us the 640. If I double click on this, we'll put a negative in front of it. And then on the cost of goods sold is the other side of that transaction. So now 800 is what we sold it for, 640 cost. Notice the net income isn't affected by the fact that we already got paid 300 of it, right? Because the fact that we already got paid isn't the time that we did the work under the accrual system. So just pointing that out. So then we're going to say, let's put a total down, an underline underneath of this. And wait a sec, right there. Home tab, font group underline, boom, shakalaka. And then we'll, holding down control, I'm going to underline those two. And then we'll bring down the balance, baby. And so we're going to say this equals the sum of the prior balance plus the current activity, control C. And then I could, oh, what's happening? And then I'm going to do the keyboard this time just to hold down shift, and I'm doing the arrows, but I can't just paste it with the keyboard because I need to do it special. I probably could, but I don't know the keyboard stroke to paste it. Formulas only is the point. That's what I'm trying to do. Okay, so there is that. Let's see if we're back in balance. We're going to pull this one down, pull it down to boom, and then underline, holding down control. We're back in balance. Let's check our subledgers. So we have a subledger for inventory is now, or our general ledger is 5225. Let's go look at the subledger and fix it for inventory. So subledger for inventory. This number, I need to change the second number, the check figure, putting my cursor back down, finding my GL account that has the latest and greatest account. I don't think the latest is always the greatest. Like, people like to say that all the time, but I'm feeling like a lot of, especially in like movies these days, the latest stuff is lame. The latest is like the worstest, I'm telling you. But maybe people just like to say that because I guess it's a marketing strategy. It's because it sounds cool. So whatever. Anyways, so now we're back in balance here. Our subledger also is now at 1961 for inventory. So if I go over here and say, okay, is that 1961? That ties out. That is good. So notice what happened here from a journal entry standpoint. We basically simply had to record a normal journal entry like we would normally invoice. In accounting software, remember that what would most likely happen is if we made an estimate form in order to tell the client what it would cost in order to get a portion of that cost for the deposit, we might create this from the estimate form. And we already would have had a payment form that was created. So the invoice here, notice the invoice is just the same transaction. It wasn't changed by the fact that we already had a prepayment. However, so that means the impact on the general ledger account as well as the subledger is the same as the full amount of the invoice. So where does the credit come into play? The credit is already, once I record the invoice from a journal entry standpoint, the balance after the credit is correct. But from a standpoint of informing the customer, I have to send them the invoice to inform the customer, right? So I can't just tell them, hey, look, how do I know you owe us this much? Because if I look at my subledger, you already paid us $300 and I record the invoice, you owe us $1,065. No, I have to send them the invoice that shows the credit applied to it. So that means at the bottom of the invoice, once I link these two things together, the prepayment or the payment form and the invoice, then I can adjust the invoice to have the bottom of the invoice record the 300, reducing this balance of 1,365 by the 300, showing the balance that is due. That bottom part of the invoice showing that information doesn't record anything new. The $300 isn't being recorded at the point in time we make the invoice because it's already been recorded up top. Now, I just want to point out that if you used some other method trying to make the undeposited, the prepayment go into a liability account like customer deposits or undeposited or unearned revenue. Sometimes I say undeposited funds and I get that mixed up with unearned revenue because they both have that un thing. So I apologize if that happens. But if that was the case, then you end up with an added problem just from the invoicing side of things, because you have to shift the subledger going from the unearned revenue into the customer account related to the accounts receivable and then record it. So we'll take a look at that problem just so you get a feel for it in future presentations, which is another way that you might do things in like a QuickBooks, for example, or you can imagine some approaches that software like a Xero, for example, might do to do a workaround on that. So the bottom line is whatever software you are using, if you're dealing with this prepayment situation, however that might be, you might be in a rental company getting prepayments of deposits or the last month rent. You might be in a company where you have deposits on large projects or on inventory like we're doing here. You might be in an industry where you get paid before you do the work because you have a subscription model. Any of those types of things being the case, you need to see how the software deals with the prepayments and how to make the process as easy as possible on the bookkeeping side, and which I think in this case would just be to use one subledger and one account for all customer types of transactions, even though you end up with negative receivables for particular customers, because that's the easiest to see from the bookkeeping side of things, and then make an adjustment if needed for reporting purposes at the end of the month, end of the year, similar to what you would do for normal adjusting type of entries, although normal adjusting entries typically have to do with timing differences, whereas this one does not. It's two balance sheet accounts, right? Assets and liabilities. But this concept of just making the adjustment at the end of the period in order to accommodate the data input from the bookkeeping standpoint, as well as then make the financial statements right for reporting purposes, is the same. Okay, so that's basically it. Let's see over here. I think everything's rolling.